Wars are expensive. Not expensive the way a new highway is expensive. Not expensive the way a hospital is expensive. Expensive in a way that strains the entire financial architecture of a country, sometimes to breaking point. The question that almost nobody asks when a war begins is a simple one. Where does the money actually come from? Not the political answer, not the ideological answer, the financial answer, the mechanical answer. The answer that explains why wars produce inflation, why they produce debt that lasts generations, and why the people who pay the final bill are almost never the people who decided to go to war in the first place. This video answers that question. 3 channels, real historical numbers, and the identity of who really gets the bill, every time. Every government in history facing a war has faced the same arithmetic problem. Military spending in a major conflict can reach 30, 40, even 50% of a country's entire economic output. In peacetime, most governments spend 15 to 25% of GDP on everything: roads, hospitals, schools, salaries, pensions, combined. War does not replace that spending, it adds to it. The gap between what a government collects in taxes and what a war costs has to be filled somehow. History shows 3 ways governments have filled that gap. Each one has a different cost, each one falls on a different group of people. Understanding which channel is being used tells you exactly who is about to pay. Channel 1, taxation, the most honest of the 3. When a government raises taxes to fund a war, it is being transparent about the cost. It is saying, this war costs this much, and we are asking you, the current generation, to pay for it now, through higher income taxes, higher sales taxes, or new levies specifically created for wartime. The economic consequence of tax-funded war spending is immediate and direct. Higher taxes reduce household purchasing power. Families have less to spend on goods and services. Private consumption falls. Business investment contracts. The economy shrinks in the civilian sector as resources are transferred to the military sector. Historically, taxation has covered only 30 to 50% of total war costs in major modern conflicts. The reason is political as much as economic. Raising taxes to fully fund a war requires public support, sustained, deep majority support. Wars that lose public support cannot be funded through taxation alone, because the political will to raise taxes evaporates. The economic advantage of tax funding is its honesty. The cost is visible. It is felt immediately. There is no hidden transfer, no deferred cost, no inflation. The bill is presented and paid in the same generation that incurred it. For exactly this reason, governments rarely fund wars through taxation alone. Transparency about cost tends to reduce public appetite for the conflict. The numbers make the taxation gap concrete. In the largest conflicts of the modern era, tax revenues typically covered 30 to 45% of total war expenditure. The remaining 55 to 70% had to come from the other 2 channels. A government spending 40% of GDP on military operations but collecting only 25% in taxes faces a gap of 15 percentage points every single year the conflict continues. For an economy with a GDP of $1 trillion, that gap is $150 billion per year, each year of conflict, to be filled by borrowing, money creation, or both. This arithmetic, not ideology, is why wars almost always produce debt and inflation. The numbers simply do not balance through taxation alone. Channel 2, borrowing, the most common method and the one with the longest tail. When governments borrow to fund wars, they issue bonds, financial instruments that promise to repay the borrowed amount plus interest at a future date. Buyers of these bonds, banks, pension funds, foreign governments, ordinary citizens, are lending money to their government today in exchange for repayment tomorrow.
The immediate economic effect of war borrowing is less contractionary than taxation. Bondholders give up purchasing power today voluntarily. They chose to lend and receive it back in the future. The government gets immediate spending capacity without immediately reducing private consumption in the same way taxation does. But borrowing has a cost that taxation does not: interest. Every bond issued carries an interest obligation that must be paid year after year until the bond matures. Governments that borrow heavily during wars emerge with debt-to-GDP ratios exceeding 100%. At that level, interest payments alone consume 10 to 20% of annual government revenue every year for decades after the war ends. The people paying that interest are the post-war generation, not the wartime generation. The borrowing shifts the cost forward in time. Future taxpayers pay for past wars through elevated taxes and reduced government services for decades. This is the defining feature of war debt. The generation that fights is not the generation that fully pays.
War bonds have been marketed throughout history as patriotic instruments. Citizens buy bonds, the government gets funding, and the citizens do eventually get repaid in nominal terms. But here is the hidden cost that bond marketing never mentions. If inflation rises significantly between the time bonds are issued and the time they are repaid, which almost always happens during and after wars, the real value of the repayment is less than the real value of the original loan. A citizen who buys a war bond for $1,000 and receives $1,000 back 10 years later has been repaid in nominal terms. But if prices have doubled in that decade, as they often do in wartime economies, that $1,000 now buys only $500 worth of goods. The citizen lent $1,000 in real terms and received $500 in real terms. Nominal repayment in full masks real loss of purchasing power. The bondholder has partially subsidized the war without being told they were doing so. Channel 3. Money creation, the least visible and most economically destructive of the three. When taxation and borrowing are insufficient, or when the political will for both runs out, governments direct their central banks to create new money. In historical periods, this meant literally printing banknotes. In the modern financial system, it means electronic money creation. The central bank purchases government bonds, crediting the government's account with newly created money that did not exist before. The immediate effect is that the government has purchasing power it did not have before, without taxing anyone, without borrowing from anyone. The delayed effect is inflation. New money entering an economy does not create new goods or new productive capacity. The same quantity of goods now has more money chasing it. Prices rise. The purchasing power of every existing unit of currency falls. The inflation tax is uniquely regressive. Wealthy individuals hold their wealth in real assets, property, equities, commodities, whose prices rise with inflation. Their wealth is preserved. Ordinary people hold their wealth in cash, bank deposits, and fixed income instruments, whose real value is destroyed by inflation. The inflation tax falls most heavily on those least able to absorb it. In the most extreme cases, where money creation was used as the primary funding mechanism, hyperinflation followed. Currencies lost 90, 99, even 99.9% of their value. Savings accumulated over lifetimes became worthless. The economic destruction extended far beyond the war itself. The three channels work together in a predictable sequence in almost every major conflict. Phase 1. War begins. Taxes rise. Public support is high. Tax revenues increase but fall short. Borrowing begins. Bond markets absorb initial issuance. Phase 2. War continues. Tax revenues plateau. Bond markets saturate. Interest rates rise. Money creation begins, quietly at first. Phase 3. Inflation accelerates. The real value of existing debt erodes. The government benefits. Its debt burden shrinks in real terms.
Ordinary savers suffer. Their purchasing power shrinks. The hidden transfer from savers to the state is complete. Phase 4. Post-war adjustment. Debt remains elevated for decades. Taxes stay high. Austerity reduces public services. The generation that did not fight pays the bill. This sequence has repeated across every major conflict in the modern era. The channel mix varies, but the identity of the ultimate bill payers is consistent. It is never the decision makers. It is always the ordinary holders of the currency. 6 things to understand about how governments pay for wars and who really gets the bill. 1. There are exactly 3 channels: taxation, borrowing, and money creation. Every war in history has used some combination of all 3. Understanding which channel is being used tells you who is paying and when. 2. Taxation is the most honest channel. The cost is visible, immediate, and falls on the current generation. For exactly this reason, it covers only 30 to 50% of war costs. Transparency about cost reduces political support for the conflict. 3. War borrowing shifts the cost to the future. Post-war generations inherit the debt and pay it through elevated taxes and reduced public services for decades. Debt to GDP ratios exceeding 100% following major conflicts are historically documented. Interest payments alone consume significant fractions of annual government revenue every year, long after the fighting has stopped. 4. Money creation is a hidden tax. New money does not create new wealth. It redistributes existing wealth to currency holders through inflation. The inflation tax falls most heavily on ordinary savers and wage earners, while wealthy holders of real assets are largely protected. 5. War bonds often deliver negative real returns. If inflation between issuance and repayment exceeds the bond's interest rate, which historically it often does, the bondholder has subsidized the war in real terms without being told they were doing so. Nominal repayment in full masks real loss of purchasing power. 6. The people who pay the final bill for wars are almost never the people who decided to go to war. Decision makers hold real assets that preserve value through inflation. Ordinary savers, wage earners, and future taxpayers hold precisely the instruments whose real value is destroyed by the combination of inflation and elevated taxation that follows every major conflict. This is not a conspiracy. It is the arithmetic of war finance applied consistently across a century of modern conflict. 3 channels: taxation, borrowing, money creation. The mix varies. The outcome is consistent. Someone always pays. And the mechanics of who pays and when are written in the financial architecture of every conflict that has ever been fought. Understanding these mechanics does not require a position on any war. It requires only the willingness to follow the money. Hit like and subscribe to FINOBOARD. In every video, we decode one financial system with real numbers and no agenda. Share this with one person who has never understood where war money actually comes from.